Hello, this is Japanese Economic Review Channel. Today, I will present Japan's money stock data for July 2026, released by the Bank of Japan on August 12th. These figures reveal a major structural shift in our financial landscape. Over the past few months, we have observed a growing divergence between traditional money supply and broader market liquidity. Today, we will examine how capital is shifting from stagnant bank deposits into active market instruments. While Japan's total money stock continues to expand, its quality is undergoing a dramatic shift. Money is no longer just dormant in savings accounts. Instead, funds are actively moving into investments and diverse corporate funding. Traditional core money growth is stalling, while broader liquidity components, such as investment trusts, plus 3.1%, and commercial paper, plus 6.7%, are experiencing rapid growth. To understand this shift, let us clarify our definitions. As shown, Japan's money stock is structured in layers. M1 represents cash and checking deposits. M2 adds savings deposits, and M3 includes all depository institution balances. Finally, broadly defined liquidity, or L, covers everything in M3 plus pecuniary trusts, investment trusts, corporate bonds, commercial paper, and government securities, capturing active capital in the market. In July 2026, Japan's broadly defined liquidity reached 2,338.4 trillion yen. Under this, M3 stands at 1,641.2 trillion yen, including 980.6 trillion in deposit money and 109.9 trillion in cash. Crucially, the non-M3 portion of L totals about 697 trillion yen. Within this, trust assets, comprising 487.5 trillion in pecuniary trusts and 126.0 trillion in investment trusts, now total a massive 613.5 trillion yen, becoming the second largest pool of wealth. Since spring 2026, we have seen a clear, quote, divergence between core money and broader liquidity. In July, while M3 grew by a modest 1.4% year-over-year and M2 by 2.2%, broadly defined liquidity accelerated by 4.4%. This gap proves that credit expansion is increasingly bypassing traditional bank loans and flowing directly into market-based financial instruments, signaling a structural transition toward direct financing. A closer look at core funds reveals the stagnation of highly liquid money. In July, cash in circulation remained flat at plus 0.1%, while checking-style deposit money contracted by minus 1.2%. This contraction indicates that depositors are no longer willing to hold low-yield liquid funds. Instead, they are rotating capital into quasi-money, such as term deposits, which grew by 4.3% in search of yield. Where is the capital going? This chart ranks the fastest-growing components of broadly defined liquidity. The clear leader is financial institution-issued commercial paper, surging by an extraordinary 166.7%. Ordinary corporate bonds followed at plus 68.2%, and government securities at plus 18.8%. In the asset management space, investment trusts, plus 3.1%, and pecuniary trusts, plus 1.8%, continue to post stellar growth. For years, Japan has promoted the shift from savings to investment. The macro data proves this is finally a reality. The combined scale of pecuniary and investment trusts has surpassed 613 trillion yen, with both consistently posting double-digit year-over-year growth. This steady monthly expansion signals a permanent behavioral change in how households and corporate treasuries manage their wealth. In corporate finance, we see firms aggressively securing liquidity. Financial institution CP experienced high volatility, moving from 911.4% growth in June to a still massive 166.7% in July. Meanwhile, corporate bonds grew by 68.2%. Firms are building strong liquidity buffers via debt markets. Additionally, as domestic sovereign debt growth slows, foreign bonds rose by 6.1%, showing a portfolio rotation toward higher-yielding foreign assets. In conclusion, the July 2026 data highlights three defining trends. First, core money supply, M2 and M3, is stable but slow-growing as idle cash holding declines. Second, broadly defined liquidity is accelerating, driven by debt markets and corporate funding needs. Finally, trust assets and investment vehicles are becoming the dominant destination for national wealth. For institutions, adapting to this market-driven environment is a strategic necessity. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.